The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. Again, thanks to all of the great emails and calls we got from last week's show. It was another interesting show regarding the markets. And today we're going to do something a little bit different. You know, for the past several months, I've always had a guest that I've interviewed, and we've talked about topics in the market and things that are going on in the economy and the world that are germane to you as an investor. And today what I wanted to talk about, and this is based on some feedback that we've been getting from some listeners, is really more on the retail side, more on the independent, personal financial management, wealth management side. And that's something that I'm involved heavily in, and it's a vast, large part of my job. And so what I decided to do today was, instead of me being the interviewer, I'm going to be the interviewee. And I've invited Kevin Lane, our Chief Investment Officer, back to the program, and he's going to pepper me with questions that I actually don't know what they are. And so we're going to get some insight as to what I'm calling sound financial management and sound financial planning. So we're going to talk about some of the things that come up in financial planning that I see that I don't necessarily agree with, but things that you need to think about and things you need to be asking your advisor, or in even a better way, asking us. And we'll be happy to shed some insight. So Kevin, welcome back to the program.
Thanks, Peter. Appreciate it.
And so today I'm the interviewee, so have at it.
Here we go. So thanks for having me, and I want to welcome my guest today, Peter Weitz, and I will be playing the fake Peter Weitz today. So Peter, we talk about, almost on a daily basis, amongst ourselves and, within the confines of Fusion, and obviously yourself interacting directly with customers about, specific financial plans and goals. A lot of times you inherit business from, clients that are unhappy, with maybe other places they've been. And, maybe you could talk for a minute about, what are some of the, common pitfalls or things that you see that when you inherit an account from maybe a disgruntled client, what do you see that the other advisors are typically doing wrong in these cases?
Yeah, sure. Thanks. I'm going to start it out with this, Kevin. The first question we always ask to a prospect is, what do you own? But more importantly, why do you own it? And I think it's an important question because, as you can imagine, the answer is typically, I don't know, or I bought what I bought because my broker told me that that's what I should have. And I find it interesting because here it is, it's your money, it's your savings, it's your future, and you really don't have a great idea as to what you have and for what reason. But if I were to ask that same prospect, what kind of car do you drive? They're going to tell me exactly what the model is, what kind of features and options it has in it, what they compared it against, what they paid for it, how they beat the MSRP, and so on. And they know everything there is to know about their car, but yet they don't know anything about what's in their account. And I find that to be the first flaw. I think that, one of the things that separates us and what we do differently is we educate. And, I've said this to you many times. Not only do we come out and you come out with a statement as to what we want to buy, but we actually come out with a statement as why we want to buy it and how long we want to hold it for and how much we expect to make. Now, we're not always right, but we at least have conviction and we have empirical and fundamental data that allows us to make an educated decision. So I think the first pitfall I see is that my future clients and my existing clients have to become more educated. I need to make sure they understand what they own. The second thing I find is that when I look at a bunch of investments inside of a portfolio, I don't necessarily know what the purpose of those investments are. And I think the second critical question I ask is, what are we trying to solve for here? We go back to math and we go back to our basic algebra. We got A plus B equals C. Well, C is ultimately your outcome. It's ultimately your desired level of retirement, or what you think you want to get to and accomplish. But if you don't know what that answer is, how do you actually know what to put inside of your portfolio to achieve it? And so I don't think that a lot of our prospects that are out there have a good enough idea of what they're trying to solve for, what their goal is. So, Kevin, you and I talk a lot. When you decide to purchase a stock inside of your portfolio, you have an idea of what you think the stock price is going to go to, and that's your goal. And as a result, you know what you want to buy it for and you know what you want to sell it for because you know what you're trying to achieve. I think our investors need to go along the same lines.
Now, one of the things that I've seen a lot that happens is, and maybe you could elaborate on this, a lot of times, the accounts that, come in that are new business to yourself or to Fusion, a lot of times, you see the portfolios and every portfolio looks the same. It's as if everybody, owns GE and owns IBM and owns. Could you talk about maybe, how you structure a plan that's, different than maybe the garden variety plan that, maybe a lot of the larger firms just think, oh, this is what we should own because, nobody goes wrong owning, IBM or GE, and maybe talk about how you differentiate that process.
Yeah, sure. The first thing I look at, and when you look at a portfolio is obviously there are IRAs, there are 401k rollover accounts, there are savings accounts / brokerage accounts. And so you've got many different titled accounts. But in the aggregate, it's still the same total value of dollars that are inside of a client's portfolio. So the first thing we look at is, what are the total dollars that we are considering here, and what percentages of those dollars do we want in certain asset classes? And I'm going to call asset classes as cash, stocks, bonds, and alternatives. Okay? So we have to decide what that breakdown or percentage of the portfolio is going to be. From there, I think a lot of times, and what I see it's different is there's not a good disparity or a good understanding of taxable versus non-taxable accounts. And so I tend to see a lot of equity-related or stock-related investments that accrete in value, that go up in value in taxable accounts, and I see fixed income, cash, and alternatives in non-taxable accounts. And so in a non-taxable account, I'm talking about an IRA or 401k rollover tax-deferred account where any buys and sells you make, any gains you make are tax-deferred until you're age 59 and a half. And at that point, it's when you actually spend the money. But to me, if I look, Kevin, at your long-short strategy, and it's going to have, 200% turnover where every position is turning over annually 2 times, it's obviously, if you're doing well, it's going to have a lot of tax capital gains, short-term capital gains factored into it. So for me, if I'm going to take my equity positions or my equity holding percentages and want to put that in a tax-deferred account so that you can have at it, run your equity strategy as you see, make as much possible money for the client, but not have to recognize those tax gains. Conversely, I would do the same thing with fixed income, that the slower paced, longer term, not as highly turnover and gross up in profit side fixed income and cash, I would want to put into a taxable account so that I could mitigate some of that tax exposure. And I see this a lot. I'll give you a quick example. We just brought in a client, a nice size relationship, a 7-figure relationship, and it was a single female, 38 years old. So obviously, in the peak time of her working profession, a solid job, making a nice income, a good saver. And I saw that in her IRA accounts were all fixed income, and in her taxable account was all stocks. And I asked her why this was the case, and she said because her broker told her that this is how it should be set up. And in my mind, that was completely backwards. 38-year-old's not going to be spending money in their IRA for at least 20 years. They should get the full exposure of the stock market and grow that as fast and as big as they can and not have to worry about the tax implication. And the fixed income side, while at 38 you probably shouldn't have a lot of exposure to fixed income, should be in the taxable account.
Another interesting dynamic I see between, advisors and clients, and I know you see this all the time. In fact, when you were just up in Boston, we were talking about this over dinner. That a client-advisor relationship sometimes it's hard. It's hard for that client to break up with the advisor, even though, and in the case we happen to talk about, the client in the instance you talked about hadn't really made any money in their portfolio in about 5 years. They were paying the advisor/broker 2% annually on the assets for about 5 years. So the advisor was, getting paid their full 2%. The client made basically next to nothing for 5 years, maybe even slightly lost or slightly gained. But basically, generally, the advisor made out well. The client didn't make out well. And really up until you sort of brought up, that question to the person, they really didn't even think about it in that regard. And, could you talk about, why you think that dynamic exists? Why do, clients sometimes stay with, an advisor that may be, a good person, but maybe just is performing poorly? What keeps them locked in there instead of searching out, what's better for your money? Because I know at the end of the day, if somebody said, well, hypothetically, if you could stay here, you could earn no money and pay a lot, or you could go here and have the potential to maybe earn a lot of money, and you may still pay for earning that money. Of course, I'm going to want my money to be treated, the best it can possibly be. But yes, that doesn't seem to happen in real life. Maybe you could talk about that quickly.
Yeah, and you know what? I think it's actually, Kevin, a little bit of a longer answer than a quick one, and it's actually going to be a good time. We're going to take a quick break, and when we come back from the break, I'll answer that. You're listening to the In Black and Weitz radio program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz, or as I should say, I'm the substitute host, but the guest of the day. I'm being interviewed by Fusion Analytics and Fusion IQ Chief Investment Officer Kevin Lane, and we're talking about the things that I see as a financial advisor from, prospects and new clients from transitioning from their predecessor broker over to me, and some of the things that we do differently here at Fusion that I think makes the experience a lot different. And prior to the break, Kevin was asking me about what I see in terms of what's the pushback from a client to leave their existing broker, and why do they stay in it too long? And I think it goes back, Kevin, to two things. Number one, I mentioned at the beginning of the show that most of the clients that I take on don't have an understanding of what they own and don't have an understanding of why they own it. And so it's very easy for an advisor to tell a client that they're in the right investment, they're in the right thing, because they don't understand what they have in the first place. And I think it goes even one step further to sound. If you were to look at sound financial management and sound, financial practices and discipline, let's again go back to your long short strategy. When you buy a stock, okay, you have a discipline in that you're going to buy it at this and you're going to sell it at this. And if it doesn't work, you emotionally aren't married to that stock, and you're more than happy to know that you made an error and get out of a costly position before it gets even worse. And I don't think, and I think from a money management perspective, that's easy, but we have to take the emotion out of it with our investors, with our clients. And sometimes I get emotionally attached to an advisor, yet they're not doing the right job. And so one of the things I hear the most, or one of the things I ask the most, is I ask about client contact. And that's the single largest reason why people make changes from their advisors. It makes no sense to me, because you would think performance should be number one, but lack of contact is the first. And so we were talking prior to the break about a client that was having no performance, yet the broker was making a great fee, but the client wasn't making any money. So here it is, the broker's making money, the client's not making any money, but yet they hang in there for 6 or 7 years in an investment that doesn't work. And I think that it comes down to the lack of understanding by the client, and the lack of knowledge by the client makes it difficult for them to make a change. They don't know the questions to ask to be able to interview who could be the right broker for them. And how do we get past that? We're more transparent and we're more upfront. We will tell you if we're the right fit for you or not. And I think because of that, our relationship and our relationship building over the last several years has grown tremendously.
Well, it sounds like from what I'm hearing, two things. And first, it sounds like, it's really a partnership. And, to be successful, and the client has to have input in the process. And it sounds like in some of the cases, maybe what you're seeing is that the client is placing almost all of his trust in the advisor, but not being educated enough, doesn't know that if the trust they're placing in that advisor is warranted or not, and basically, therefore don't know if their portfolio should change or should be shifted or should change, and that's part of the problem, it sounds like.
Yeah, and I think it goes one step further. I mean, we make it a point to really get to know our clients on a more personal level. And it's easy to do because we contact them once a month. So if I'm calling my client once a month, I'm going to know what's going on in their life. Now, we may not have anything to talk about as it relates to their portfolio, but at least that contact keeps me engaged. And it's an interesting point, because what I'm trying to do is make as much money for my clients, but also have them actively involved, as you just mentioned. So an example of that is I have a client in the Boston area, and she likes socially responsible companies. So one of the things that we do from an investment perspective is we look for companies that are socially responsible in the way that they treat their employees, the way they treat their environment, the way, they do all these, green related things. And what's even better is that I can then report back to her and say, hey, the following mutual funds or the following stocks are socially responsible. And if it's a retail company, for example, she can actually say, oh, I didn't realize this company was socially responsible. I'm going to go to that store and shop there because they fit within my, psychological way of things I think about. And so that engagement, I think, helps us to keep our clients involved in what's going on inside their portfolio.
Earlier in the show, you talked about, and I think this is interesting because I've seen it, over the 16, 17 years I've been in the financial services industry. People will know everything about the car they buy. People will go to Consumer Reports and read for hours before they purchase a washing machine. But yet, putting $1 million to work in the marketplace or more or less, and spend not nearly as much time or just not want to be bothered with it almost and say, you know what, I'll let my advisor handle that. And I know you're very active about wanting your clients to understand what they own, why they own it, and, how that is going to help them reach their goals. And, again, I guess it kind of falls back to that education part, and that a lot of advisors maybe aren't educating the client, and you want to take them along sort of every step of the way. So if I'm a client, besides obviously reaching out to you through voicemail or email or the radio show, and I happen to be in the Florida area and I wanted to stop in, well, take me through, Kevin Lane coming in off the street to your offices, kind of what you would do with me.
I mean, the first conversation, if you were a new prospect, is going to be more fact finding than anything. Again, I alluded to in the beginning of the show. It's an algebra equation, and I need to know what I have to solve for. And if I don't have a solution, then I can't give you. Or if I don't know what the problem is, I can't give you a solution. So the first thing I need to do is understand you, your needs, your goals. And once I know that, I can devise a strategy that can fit. On a regular basis, if you were to stop by my office or call on the phone or email, we're going to talk about where we are in the market, how we're doing performance-wise. And, just like, Kevin, you and I did a show several months ago. In the beginning of the year, we gave an overview of the top 10 investment themes that we think are going to make an impact this year on people's accounts.
Sure.
And so, obviously we use those themes and we talk to people on a personal level in their portfolios because that's where we think we're going to make money. But, we went again on the show and we graded ourselves as to how we're doing against the themes that we suggested would work well. And some we did very well on and others we didn't do so well on. And, as data and information becomes available to us, we make changes. And I think from an ongoing basis, that's the kind of thing that we talk to our clients about. We tell our clients, listen, we're not always going to be right, but we have to be on top of this to have the ability to be able to make changes when the changes need to be made. And so we constantly, when we see them, give ourselves a report card. Here's where we are. Here's what happened. Here's what's going on. Here's why we won. Here's why we didn't do so well. What are we going to do to make changes to go forward?
Well, and I think that's a great lead into, the debate between, active management and passive management. And maybe, you alluded to it that obviously we take a very active approach. Maybe you could talk about active versus passive management, for the listeners, explain the differences between the two, and why you lean towards one more than another.
Yeah, I mean, we've talked about this. It's been a recurring theme on this show. And, I'm not saying that I'm against indexes or exchange-traded funds. I'm not. We use them a lot as an effective alternative to mutual funds. But those ETFs and the allocations that you use them inside of a portfolio or index funds have to be managed by a professional. And the reason is that things happen. Things happen quickly. And if you can't adapt, then these massive losses that are loomed in 2008 are going to take you a long time to get back. I mentioned earlier, Kevin, and I'll just take a quick aside, is that in my active versus passive discussion, that our line of thinking is very tactical, meaning that we believe that we either want to be invested or not. And for us, a big drawdown in an account, a 30 or 40% drawdown, or 47% that you saw in 2008, is so hard for us to recover from that we would much rather have less on the upside but be able to control what happens on the downside. And we've had several of our managers that we use on this program back that up with data for us. So if I were to look at an index, the index basically just takes the market cap weight of a stock and gives it a percentage ownership inside of an index, and that's it. So if those stocks go up or down, there's no way to adjust how that allocation works. And so you're either going to ride it all the way up or you're going to ride it all the way down, but you can't get anything in between. And I can prove, and we've done this, and I've got it on the blog and I've got it on the website, that in most cases, not in all cases, the S&P 500 be a tough one, but in most cases, active managers over time can outperform indexes or ETFs, in most cases, net of fees.
Well, there's an interesting piece, and we've talked about this a little now in the mutual fund industry. They'll tell you, well, it's hard to time the market because if you miss the 5 best days every year over a long period of time, that your portfolio will suffer. Of course, because when your money in a mutual fund goes, from a mutual fund into the money market, if you were to, quote unquote, try to time the market, they don't get paid on those assets because now they're sitting in the money market. So, of course, they sort of perpetuate these statistics that, well, if you try to time the market, you miss just the 5 best days every year, your portfolio is going to dramatically suffer. Of course, what they don't tell you is if you avoid the 5 worst days every year, you do far better than missing the 5 best days. So, it's sort of a shaded argument on their part, if you will, and I think it lends to the idea, of tactical. And case in point you made, which is perfect, and we saw it in 08. 08 wiped out, in essence, for some people, 12, 13 years of gains in a year. And you can, as we always say, when we're talking and kind of using analogies, you can take a flesh wound and survive that. You can't take a bullet to the head. And I think that's the difference, in a nutshell between active and passive, and where we try to be active is we may not always be right, dodging some of the fire sometimes, but, we're trying to avoid the bullet to the head, which really can kill your portfolio.
Yeah, I think that's a great analogy, and I'm writing it down as we speak. But, Kevin, we're going to take a quick break. When we get back, feel free. I don't know where we're going next, but I look forward to the conversation. You're listening to the In Black and Weitz radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. Couple things. If you want to email me, please email me at peter@inblackandweitz.com. You can follow me at Twitter at Peter Weitz or follow our blog inblackandweitz.com. We're always posting some interesting data and statistics. I'm joined today by my guest host, Kevin Lane, who is the Chief Investment Officer and Managing Partner of Fusion IQ. And he is interviewing me with asking questions about what are some of the things that I see when I take over a personal investment account from another financial advisor in the marketplace, and some of the things that I think that investors need to ask or be aware of in the market so they know that they're getting the best advice and have the best financial investments available to them. And so prior to the break, we were talking about some of the things that prevent a broker or an investor from making a change to a new broker. And I wanted to comment on one thing. I think I'm not really sure that, and we're talking about this education piece, that investors are crystal clear on their level of risk and or their tolerance for risk. And you see that a lot because we were talking about drawdowns in the market. And, you know, there's data out there, there's statistics out there that say that, you know, a loss hurts 10 times more than a gain. And, you know, even today, people are talking about 2008. I lost all this money in 2008. Well, you know, here it is. It's 2014. That's, you know, that's 6 years ago.
And the market's up 193% from the
exactly, Kevin. Yeah, the market's rebounded 193%. Well, if you're still reeling in the loss of 2008, you missed 193% of upside. So one of the things that's, you know, I want to allude to, Kevin, is, you know, we have actually on our website at fusioninvest.com, we have a great questionnaire we call a risk profiler. And it's, you know, it's no obligation. It's free of charge. It's available to anybody. Just go onto the website and click on the link for Risk Profiler. And it'll ask you a series of questions, and it'll tell you what your investment risk tolerance is. And, you know, I propose to our listeners out there that you should take the Risk Profiler, you know, questionnaire and marry it against your current investments and make sure that you are aligned. I think that's critical. It's a great place to start.
Well, you know, I mean, and you know, that's the great about the web. You know, I mean, there are these tools that you now have at your disposal, make it seamless. You know, there's no time-consuming effort to it. You can do it, you know, on a pad, you know, on a phone, on your computer. And I think people don't necessarily always understand their risk tolerances. They think, you know, until an event happens, they think, oh, this is what my risk tolerance is, and, you know, I'm pretty comfortable with the volatility in the marketplace. And then all of a sudden it happens, and it's completely different. And I think we've structured the way the questions are worded and, you know, understanding, you know, sort of, you know, from an expert questionnaire basis to really try to pull what your true risk tolerance is out of there. And again, I think it's a great tool, and, you know, kind of just your tolerances change over time as well, too. I mean, obviously, from the arc of an investor that's, you know, 35, high income, no kids, all the way towards retirement, and so we always, and I know you, Peter, do sort of annual revisits with clients in terms of risk tolerance and has anything changed, and maybe even more frequently than that. So, again, it's just a great way to kind of gauge, because you may think you're one thing, but, you may find out you're something else.
Well, yeah, and you know what else, Kevin? I was thinking about this in our conversation is that, and you and I we do this frequently, but, one of the things we do differently is that before I suggest a solution to the client's ultimate goals and needs, we go out and decide, we go out and interview, we go out and vet the vendors of the products that we use. You and I were just in Boston last week speaking to a multi-billion-dollar money manager to make sure that their process and the way that they handle assets align with our line of thinking. And I think that's a big differentiator. I mean, I don't know a lot of brokers that are taking the time out of their days to go visit in-house with the people they do business with to make sure they're the right fit.
No, that's true. I mean, and on top of that, I think what's interesting as well, and as you said, we're really getting under the hood of what they do. A, does it tie into what my client wants? B, is this the kind of product that could be helpful to my client? And interestingly enough, and then with in-house, with our long-short strategy, not only do we interview, potential outside managers, because, we're smart enough to understand that as smart as we are, there's other managers that can offer some value. So we have some, managers that, come from outside Fusion that are on our platform. And, of course, we have our in-house strategy. But even with the in-house strategy, Michael Needleman, who was your guest last week, I mean, he's constantly, interviewing companies, talking to CEOs about the business trends, about various competitive advantages or disadvantages they may be at to determine if even one stock is worth, being put into, our long-short strategy. So I think that is true. Not a lot of people do, that additional due diligence. They're relying more on, sort of, star ratings and things that, maybe not be as more accurate as you can get face-to-face.
Right, and that's something that's important to us. And I mean, we go, we make sure that we vet who we do business with to make sure they're aligned with our line of thinking. And, I go back to the old football coach, Bill Parcells, who made a statement that said, you can't expect me to cook the meal if I don't get to buy the ingredients. And so if we don't know, if we don't know everything that we're buying, we're obviously not going to make very good food.
Well, right, and that education process, as you put it, to educate, the client, also starts with us being able to understand the product. And, I've sat with, lots of advisors, lots of larger firms. I won't name any, but, I would mention something about a product, and it's, I don't know. This is what they just told me to buy in-house. And I was kind of taken aback thinking, wait a minute, you don't even understand the product you're selling to your client. That's, like Rule 101. And so it's refreshing, I think. And that's, I think, kind of the advantages of working, with a smaller firm, sometimes a boutique, is that, you get more personalized service. I had a client, of the firm one time tell me that, he walked into XYZ, largeshop.com, whatever, and he had a $10 million account. And they left him waiting in the lobby, for about 2.5 hours, as if he had $5 to invest, because at this particular firm, really $25 million and up accounts get the service. And I was appalled to think that anybody would be that arrogant that, regardless of the money, whether you're investing $100,000 or whether you're investing $10 million, you should get the same level of client service. But I was shocked. I couldn't believe that. And he felt, very mistreated, that they would leave him out there. Here he is walking in thinking, hey, I've got a sizable investment portfolio. I think you guys could do a good job. And then they just let him sit in the lobby for 2.5 hours. It was mind-boggling. So I think, I think that's why we all started, Fusion and to come together was, having that boutique experience and really being able to deal with the customers, on a one-on-one basis.
Well, and even more so, we're agnostic to really what we invest in.
Right.
I know our interests are aligned with our clients, and so whatever we purchase, it's because it makes the most sense for the client. It's not because we're pushing a particular product for any particular reason. We actually don't have any, like I said, we're agnostic. We don't have any interest in one product or another. We just want the best for our clients.
Understood. And that's a great point, because I don't think a lot of people, necessarily understand, the conflicts of interest and things of that nature. And I know you've talked about this before, and, without naming names, we don't need to, but maybe you could talk about, how those conflicts of interest led you to want to do better for your clients, and move into a place where you could be agnostic.
Yeah, great point. I mean, I worked for a wirehouse, and I worked there for several years. And in 2008, when the market was starting to, its crumble, my partner and I made the decision that we felt it was appropriate to put our clients into cash. And it was the right move for our clients. Unfortunately, wirehouses don't pay us, and I have to earn a living just like everybody else. They don't pay us when our assets sit in cash. So we did the right thing by the client and did the wrong thing for ourselves. So I had this inherent conflict of whose interests are best served, mine and my family's or my clients. And that was when I decided I could not run a business that way, where I'm not on my interests and my client's interests need to be aligned on the same page. And it was that decision that led us to, go to the registered independent advisor channel, because it allows us to not have that conflict.
And talk about that. I think that's an important point, is that the decision and the knowledge to move to cash and potentially save a client from missing a portion of 08 or what have you, how that is a value-added portfolio tilt. Cash is an asset class, and that's why people pay you to determine whether they should be in cash or not, and how whether we're in cash or not, people are paying you to navigate them.
Yeah, and that's a good point. I mean, it was said a long time ago, and I've said this in the past, is that when you work for the big wirehouses and so forth, your advice is free, and you pay for the products. And on our side of the table now, the products are just an answer to a problem. It's the advice that you're paying for. And my advice to my clients was, it's time to go to cash. Well, that saved them from losing a vast majority of their wealth, because while we caught some of the downside, we didn't catch all of it. And so I'm in the advice business now, and that's what we're being compensated for. So it doesn't matter where your money's being held and in what asset class, cash, stocks, bonds, alternatives. I'm an advisor, and I'm being paid for advice. And that's the big differentiator. And that's why the conflict no longer exists between our clients and ourselves. Kevin, we're going to take a quick break. When we get back, we're going to talk a little bit more about our strategy. But you're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. We're joined today by my co-host for the day, Kevin Lane, who he and I have been having an interesting conversation about principles that we believe in that create sound investment decisions on behalf of our clients. And prior to the break, Kevin, we were talking about some of the things that, clients do and things that we think about to help mitigate risk. And I want to continue that conversation.
Yeah, well, the one thing I wanted to, kind of touch on as we were coming out of the break, and they cut me off right at the perfect time, but, rumor has it that your favorite movie is actually The Blind Side, and you don't consider yourself a financial advisor, but rather a financial left tackle. And I know we razzed you about that around the offices for a while, but why don't you explain?
Sure. I mean, I didn't know you were going to go there, but several years ago, I'm watching The Blind Side. In the very beginning of the movie, Sandra Bullock goes into this soliloquy over what it's like in football, and there's that sort of moment of inertia. And what she makes a comment about is she talks about a game many years ago between the New York Giants and the Washington Redskins. And Lawrence Taylor at the time was a linebacker, defensive end for the Giants, and Joe Theismann was the quarterback at the time for the Washington Redskins. And on this particular one play, Joe Theismann is a right-handed quarterback. He drops back to make a pass, and he turns his body 180 degrees so that he's looking out towards the right, but he can't see what's behind him coming from the left. And at that time, Lawrence Taylor eluded the financial left tackle, and he was able to tackle Joe Theismann, to sack Joe Theismann, but in such a ferocious way, or I should say in such an unusual way, that it broke his leg so severely that he never played another football game again. And the comment in the movie The Blind Side was that your quarterback is the leader of your team and is probably the highest paid player on your team. The second highest paid player on your team should be the person that protects the highest paid player on the team, which is your left tackle. Because if you're a right-handed quarterback, you can't see your left side when you go back to pass. And as a result, the left tackle is the one that has to protect you. And so I equated this to my philosophy of how I invest, is that I need to play the role of the left tackle. You as the client, you as the family, you're the quarterback. It's your family, your needs, and you're the one that's going to lead us with your wealth to retirement. It's my job to protect my clients from what they can't see. My job is to protect them from the left side. And so I've always used this analogy of me being a financial left tackle and the blind side as a way to describe in a picture how I manage client assets.
And it's a great picture. And I remember, when you first came out and talked about it, and I think it was at one of the TD Ameritrade conferences or what have you. And of course, being that you work in an organization. We had to give you your ribbing, but then after that died down, we all thought, we're like, wow, what a great succinct analogy. Like you said, the client is the quarterback; they're the most valuable person on the team, and your job is to protect them from what they can't see. And what's interesting, and that happened in 2008. And I can tell you, I mean, from being in this industry a long time and having a lot of friends that are, quote unquote, considered to be amazing money managers that have been written about and talked about and, four-starred about, if you will. And a lot of them, if not all of them, were down 35, 40%, 45% in 2008. And part of that is, in my opinion, is their philosophy is flawed. First of all, most of them are long only, which means even if they see the tidal wave coming, by charter, their investment vehicle, their mutual fund, doesn't really allow them to raise much more than 10% cash. So it's not even that they're ill-equipped or not intelligent. They just, by their charter, they have to be invested as things go down. And to me, that seems crazy. And so I think we're better equipped to be left tackles because we're able to be active, whereas these guys are passive, are more equipped to maybe be the holder on a snap. So
yeah, I like to use the term.
It's a great analogy.
Yeah, I like to use the term, Kevin, that we're more nimble.
Right.
We can go to the left, we can go to the right, we can run backwards, we can run forwards at the drop of a hat because we're not tied into any one particular way of investing. And because of that,
we always say we want to swim with the tide, not against it.
Right, and we're able to adjust because of it. And I think that's what separates us, and it does tie in well with that whole left tackle and what they do in a football game.
Well, I know we don't have a lot of time left on today's show. We've kind of crammed a lot of stuff in, but I know, alternatives are kind of a hot topic now. Talk about, and typically alternatives were always considered for the uber wealthy or for institutional investors only, but now obviously with some changing, laws and things of that nature, they're opening up alternative investment strategies, for different thresholds, lower thresholds of individual investors. So maybe, could you talk first about, alternatives, what they are for the audience, and then where you see them fitting in a plan? Of course, generically, because obviously different people with different, ages to 8 years of retirement, different investable cash, different asset levels would have different exposure to alternatives. Why don't you talk about alternatives sort of in a generic way?
Yeah, sure. I mean, alternatives are what's great about them is they're an asset class of investments that aren't necessarily tied into the performance of the stock market or the bond market. And a lot of those asset classes include currencies, commodities. It could include energy stocks, could include commercial real estate. And in the commodities world, you've got things like corn and wheat and so forth. You've got, again, your currencies, the U.S. dollar, the euro, and so forth. And so having exposure.
And to backtrack just a second for the user. So when you're saying they're not tied, what you're saying is they tend to not necessarily always move in the same direction of of stocks or bonds. So stocks or bonds could go up, but these alternatives, or down, and these alternatives kind of may beat to their own drum, and they're not correlated to these other asset classes. And it gives you what, diversification as well?
Yeah, it gives you diversification. It also gives you a great hedge against a down market. So if the stock market's going down, these aren't necessarily going down. There's no real relationship, which is correlation between the two sectors of class. And it's been used by college endowments forever, and it's the reason why they're able to sustain the level of endowment because the performance over time is amazing. I'm going to give you a quick stat. From 1992, to 2005, right? So you got a 23-year period. Over that 23-year period, the alternatives portion of a college endowment, of the endowment funds, averaged a 9% return over a 23-year period. That includes 1998, 2003, and 1987. I mean, it's got some pretty bad markets in there. So I think it's a great asset class to have to consider as an alternative. And it's something that we use in our portfolios because it helps hedge and mitigate against bigger drawdowns in the market.
Now listeners will hear the word alternatives, and I know they've heard a lot of, good and bad things about them. A lot of times they're sold sort of potentially is scary. Most people think of alternatives as hedge funds. Now, there's a place in it for your portfolio. Typically, alternatives tend to offer the higher beta. They're a little riskier in nature, tend to offer higher returns. And I think it's an interesting, and maybe you could elaborate on this, because there's a new piece of news out recently, and why alternatives are supposed to be complementary pieces to a portfolio and not necessarily your whole portfolio. But Yeshiva University in New York is the oldest Jewish university. And I read an alarming article that about 5 or 6 years ago they decided to go with their endowment with all alternatives, which I know right now here you got your hand against your head as if you have a headache. And now the university, the oldest Jewish university in the country, may go bankrupt because those investments went bad. So talk about, obviously how they're beneficial, but again, they're supposed to be complementary pieces to a portfolio, not necessarily an all-in strategy.
Yeah, I agree with you. They have to be used as an overall mix of your portfolio, and that mix is not all. It's some portion, and it's all going to be based upon, as we touched on earlier, that risk profile. There's tremendous amount of data on alternative types of investing. We use ETFs, so we're not actually engaged in heavily traded hedge funds that are a lot riskier that you read about in the newspaper. But we use the ETFs that are a diversified portfolio of assets as a small percentage of your overall portfolio, and it's used to help diversify and lower your risk. But Kevin, I appreciate you being on the program. We are out of time today. I would like to continue this conversation in the future, and I really appreciate you interviewing me today. It was a lot of fun being on the other side of the table.
I enjoyed being the fake Peter Weitz for today.
Thanks a lot. Tune in next week. We're going to talk more about sort of where we are in this whole dynamic of the market. And then, as I mentioned, coming up, we got a great show on how to protect yourself against people raiding into your databases and stealing all that all-important data like you've seen at Target and others. Make it a great week. You're listening to the In Black and Weitz radio program on the Voice America Business Network. Thanks a lot.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.